She formed an LLC, got the certificate, and went back to work. 3 years later, she applies for a business line of credit. The bank requires an operating agreement. She doesn't have one. She pulls a free template from the internet, signs it, and submits it, dated the same day as the credit application. The banker notes that the agreement is dated 3 years after the LLC formation. The loan is declined. A separately dated, unexecuted operating agreement is a red flag that the business wasn't maintained properly, and banks treat it as evidence that the LLC is a shell, not a genuine operating entity. An operating agreement is the internal governance document for your LLC. It defines who owns the company, how profits and losses are distributed, how decisions are made, what happens when a member wants to leave, how the company is managed, member-managed, or managed, and what happens if the company dissolves. For a single-member LLC, many of these provisions are simple statements of fact. For a multi-member LLC, they are the contractual foundation of the entire business relationship. Many states technically allow LLCs without operating agreements, but no state's default rules work as well for your interests as a well-drafted agreement. The liability shield your LLC provides is not guaranteed simply by having the entity. Courts can pierce the corporate veil, hold you personally liable despite the LLC if you treat the business as an extension of yourself rather than a separate legal entity. Evidence that supports veil piercing: no operating agreement, commingled personal and business funds, no separate business bank account, signing personal documents in the company's name, and using business accounts to pay personal expenses without proper documentation. A maintained operating agreement is evidence that the LLC is a genuine separate entity, which is the entire legal argument you need to make. The essential provisions of a single-member LLC operating agreement include identification of the member, your name, address, and percentage ownership, the registered agent and registered office address, the purpose of the business, a statement of the types of activities the LLC is authorized to conduct, the tax classification election, default disregarded entity, or if you filed Form 2553 S-Corp status, capital contribution records, the initial money or assets you put into the business, profit and loss allocation, who receives them and in what proportion, member voting and decision-making authority. The management structure section specifies whether the LLC is member-managed or manager-managed. In a member-managed LLC, the owner manages the business directly, which is standard for solo operators. In a manager-managed LLC, a designated manager, who may or may not be a member, makes operational decisions. This distinction appears on your state formation documents and matters for who has authority to sign contracts and bind the company. Most banks will ask for this designation before allowing a signatory to open accounts or execute financing. An operating agreement that clearly states this eliminates ambiguity in every future counterparty transaction. For multi-member LLCs, the operating agreement becomes a negotiated contract between co-owners, and the stakes are dramatically higher. Critical provisions for multi-member agreements. Buy-sell provisions. What happens when a member wants to exit or dies? Drag-along and tag-along rights, whether majority members can force a sale and whether minority members can join one. Non-compete provisions between members. Deadlock resolution. What happens when 50-50 members disagree on a material decision? Dilution protections. These provisions are the operating system of your business partnership, and handshake agreements about them are not enforceable. The 5 situations where not having an operating agreement costs you money. First, bank financing. Most lenders require it for business loans above $25,000. Second, commercial real estate leases. Landlords use it to verify the signatory's authority. Third, major contracts. Sophisticated counterparties want to see governance documentation before signing significant agreements. Fourth, adding a partner or investor. You need an existing governance framework to amend, not a blank slate under pressure. Fifth, a lawsuit. A plaintiff's attorney will argue, the LLC has no governance and isn't a genuine separate entity, supporting a piercing argument. Draft the operating agreement at formation, not when you first need it. If you've already formed your LLC without one, draft it now. Date it as of the date you're drafting it. Do not backdate it. Your state's Secretary of State does not require you to file the operating agreement with them. It's an internal document retained in your business records. Keep it with your formation certificate, your EIN confirmation letter, and your first year's business bank statements in a dedicated business records file. Update it whenever ownership, management, or capital structure changes. Free operating agreement templates are available from every state bar association, SCORE, and the SBA's Learning Center. For a single-member LLC with straightforward operations, a template is adequate. For any LLC with multiple members, external investors, significant assets, or complex profit-sharing arrangements, an attorney-drafted agreement is a legitimate investment, typically $500 to $2,000 depending on complexity. Compare that to the legal cost of a dispute arising from an ambiguous or absent agreement. Multi-member LLC disputes without a governing document often cost $30,000 to $100,000 to resolve. The agreement is the cost of certainty. The operating agreement doesn't protect you from bad business decisions. It protects you from bad outcomes when good business decisions go sideways, a partner dispute, a creditor claim, a financing requirement, or a lawsuit. It is evidence that your LLC is a genuine, separately maintained entity rather than an alias for yourself. Write it at formation. Keep it current. And if you're building your LLC's legal foundation from scratch, Part 1 of the Starting a Business series covers every registration step and document you need before your first invoice. An operating agreement is one piece of a proper legal foundation. If you are building that foundation from the start, Starting a Business Part 1, the legal foundation, before you make your first dollar covers every step before your first invoice. It is on this channel.